Hey everyone, we have been getting some unfortunate news for Texas Instrument stock investors. The dividend stock and semiconductor stock is going through some tough times. So I wanted to dig into the details here, try and understand why all this unfortunate news is coming out for Texas Instruments and get an inside look at those struggles from within the company. So I'm not the only one that's noticed difficulties at Texas Instruments. So has Goldman Sachs analyst Toshiya Hari, who's asking, at the midpoint, you're telling investors that your revenue is going to decrease by 12% in the next quarter. What's going on? So Texas Instruments head of investor relations and VP says that in the fourth quarter, we did see weakness in the industrial markets. There was a sequential decline in the automotive market as well. And as the guide would suggest, we believe that we just continue to operate in a weak environment and one where customers are continuing to rebalance their inventories overall. Not great news there for TI stock investors. The company saying that in the most recent quarter, they saw weakness in the industrial market, and they think that weakness is going to continue. They think there's too much inventory in the system, so their customers are going to work through and use up their existing inventory before they order more from Texas Instruments. Interesting. So the analyst from Goldman Sachs asks a follow-up about gross profit margin. So the analyst understood that revenue is going to be weak, but what about gross margin? And the TI management team says that pricing just doesn't move quickly in our markets overall, and nor is the primary reason why a customer chooses our products. Our pricing strategy hasn't changed. And let me talk a little bit more about that, right? As consumers, we might feel sometimes that pricing is the number one thing that causes people to decide on a purchase or not. And it's not all the time. Pricing is not all the time the main factor, especially when you're working with inventories or products that are important. Then quality might be more important than pricing, or consistency might be more important than pricing. Trust and discipline. Can you trust this supplier to deliver the amounts that you order on time and in the way, in quality that you requested, right? That becomes perhaps equally as important as pricing, if not more important than pricing. So price is always an important component in a buyer's purchasing decision, but it's never the only decision. It's never the only factor. It's one of the factors, and in some industries more so than others, pricing is less important or more important. So the degree of importance in pricing changes with industry, and Texas Instruments saying that for our industry, pricing is not the primary factor that customers consider. Still, management saying that they expect low single-digit decline is what they're expecting in time, and they wouldn't describe that as unusual. So this is something they expect over time, that prices are going to decrease in the low single digits. And if you haven't seen my other videos where I explain what low single digits mean, when management teams say low single digits, they mean 1%, 2%, or 3%. So they expect pricing to decrease by between 1% and 3% over time. And then an analyst from UBS comes on to ask about factory loadings, which is in other words for utilization. How much of your capacity are you utilizing? And the management team saying, as we have neared our inventory levels, we have adjusted our factory loadings accordingly. So in the third quarter, we did some of that, and that had an impact on gross margins and underutilization. In other words, as the company's inventory has increased and they saw what customer demand is, they've adjusted their utilization lower. And so that's hurting gross margin because they're not producing as many units as they're capable of producing, and that decreases your gross profit margin. And so going into the first quarter, they're taking that adjustment further, and the fourth quarter adjustment was bigger than the third quarter adjustment. So it's increasing lower and lower, the adjustments they're making, because consumer demand, their demand is not as strong as they would like it. So the first quarter adjustment on underutilization will be even bigger. So from the third quarter of the previous year to the fourth quarter, that utilization decreased, and that utilization change will be even bigger going forward. So not great news at all here from Texas Instruments, suggesting this decline in industry demand has at least one more quarter to go, as the end markets, as the people that are ordering Texas Instruments products have too much inventory. They're waiting to work through that inventory before they buy more of Texas Instruments products. And so Texas Instruments is not producing as much because they've got an abundance of inventory that they don't want to add to. You never want to have too much inventory. You might say, well, why don't you just build that inventory and save it? And when consumer demand rebounds, you have the inventory ready to ship it out. And that's not where businesses have been moving towards. If you've been following, the main theme in business strategy has been just-in-time production. They don't want to have inventory sitting around and not going out to customers because that causes more disruption than it does in helping, right? You've got to store that inventory, so you've got to pay for storage. When that inventory is in storage, some of that inventory gets damaged over time, right? Some of that inventory gets stolen, and all of those reasons decrease the benefits of having that inventory there sitting around waiting for a customer to ship out to. So for many reasons, businesses have been working on just in time, where they reduce the amount of inventory they have, they reduce the amount of safety stock of inventory they have, and they try to align their production more closely to consumer demand or to their end market demand. So of course, if you've got all this going on, the analyst wants to know, are you actually cutting capital expenditures now? Now that demand is lower and inventory is high and end customer have too much inventory, are you now not investing in your capital expenditure because you've got more than you need? And in fact, the Texas Instrument the CFO comes on and says, no, we're not. In fact, capital expenditure came in just as expected, $5.1 billion, and we've been talking about $5 billion per year. So it was right on target, and you should expect, and we expect to continue running at about $5 billion per year through 2026. So longer term, Texas Instruments is not concerned about the end market demand for its product. It's just in the near term, as this inventory cycle adjusts, they're seeing lower demand for their products, but they're confident that the industry will turn around and they're going to be ready. They want to be ready for that turnaround in consumer demand, in their end market demand. The semiconductor industry has been a cyclical industry for decades, so Texas Instruments is used to these ups and downs. Even though this particular down cycle may be one of the more severe ones, they're still used to these ups and downs, and so they know how to adjust their business to prepare for these ups and downs and be ready for when the industry turns upward. Nevertheless, these are not good developments for the near term for Texas Instruments. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.